Hi guys, how's it going? I hope you're all doing well. In this lesson, we are still discussing how a business forms its finance strategy, and the topic that we're discussing, particularly from this financial strategy, is the topic of dividends. So, how are dividends paid out to shareholders, and what is the strategy that the business will undertake over a longer period of time? Now, what is dividend? Let's just remind ourselves it is the reward that the shareholders get for entrusting their money to the business as to for waiting so patiently for the entire year, seeing how much profit the company makes, and then what portion of that profit will be given to shareholders as their reward, which we call the dividends. So, the dividend strategy would be a company's long term approach towards deciding how much dividend should really be allocated to the shareholders as part of dividend payments. Of course, whenever you've taken money as shares, as share capital by selling shares, the company needs to pay the shareholders back as long as there's a profit being made. And you can't just think up a strategy on the day that you're supposed to pay off the dividend and just suddenly follow it. There has to be a more thought out process, a long term approach when you're coming out with a strategy. And there are three types of strategies that a company can use when they're coming up with their dividend strategy. And the first of those is where business decides to just steadily increase the amount of dividend that's being paid each year. So maybe start up with a smaller amount. Maybe let's say first year the dividend yield that you're getting, let's say 5%. Next year, might increase it to maybe a 7%. Next year, maybe a 10%. So you're saying the number steadily increasing over year one, year two, year three, so on and so forth. So that's one way a business can use the dividend allocation strategy. Secondly, businesses, and this is used quite often, is that businesses will set a fixed percentage of dividend which is to be paid each year. So let's say the business decides, look, we are going to pay 10% each year, no matter the amount of shares you have or whatever the amount of profit we have, it's a fixed 10%. So you know from day one exactly what you're going to be getting once you invest in this company. And the third type is simply it's like every year you assess what the situation is, and if there's high profit, you get high dividends. If there's low profit, you get low dividends. It's simply based on the company's performance. If the company does well, the shareholder will do well. If the company does not do well, the shareholder will not do as well relatively as also. So that's again three different strategies the business uses, and whatever the strategy is, in either case the business will either have a low payment strategy or they would end up having a high payment strategy, right? So that's something that you want to see, that then what happens to your ratio analysis, and that's really the essence of this entire lesson, that what happens to the different ratios when the company decides to either pay a high dividend each year or a low dividend. So let's compare those two situations, and starting with what happens when the company chooses to pay a high dividend each year. So we're going to look at how having a high dividend payment strategy would impact a business. And what you want to see is the impact it has on different ratios. And the different ratios that we're going to look at are the dividend yield ratio, and we'll discuss the dividend cover ratio, and then the different liquidity ratios that we know about, the current and the asset test ratio. Now, starting with our dividend yield ratio, and I'll just remind you of the formula of the dividend yield ratio, and it looks something like this: the dividend per share divided by current share price multiplied by 100. Now, let's work with a few numbers here, and let's say that at the start of a year, our dividend per year is at, let's say, 0.5. So 0.5 is our dividend per share. Let's say the share price is $2, and you multiply this by 100. So the dividend yield ratio is at 25%, right? So if you buy the share for $2, you're getting 50 cents return on it. That's a 25% return. Now, what we're trying to see here is that what happens to your DYR, your dividend yield ratio, when there's a high dividend payment. So let's say this, what we're indicating it at is that this number, the numerator, is going up. So let's say this does go up and this becomes 0.75. Okay. The rest of it remains the same. divide by 2 multiplied by 100, and this gives me 37.5%. So I'm seeing here that as soon as your dividend per share increases and when the company decides to have a higher dividend payment, so from 2.5 to 0.75, the dividend yield ratio increases. And that makes sense, right? Because what dividend yield ratio tells us that how much you're going to be earning on the investment that you're making per share. And if you're getting more reward for the same price, then you're definitely getting a higher dividend yield. So wherever there's a high dividend payment strategy, your dividend yield ratio will actually increase. Now, the dividend cover ratio, which tells you how many times does the company pay the dividend that it has promised to shareholders from the profit that it has made. And the formula for it is your profit for the year divided by the annual dividend. So once again, let's work with some numbers here. Let's say the company's profit for the year was 10 million and the dividends that they announced were, let's say, 6 million. So the company can pay the same dividend 1.67 times, right? That's simply how you do it. Now, let's say that the company decides that they're going to pay a higher annual dividend, which means our denominator is increasing now. So let's say the numerator remains the same, 10, and the denominator, let's say this goes from 6 million to 7 million, right? Let's keep it simple. When I calculate this, when I have to pay a higher dividend, 7 million, and I'm not making a higher profit, that means my ability to pay will go down, and this will then become 1.42 times. So once again, when I compare the two, I can see here that my dividend cover ratio is actually going down and the company's ability to pay a higher dividend is also going down. So what I can take away from this is that when you pay a higher dividend, your ability to pay it goes down, so your dividend cover ratio will in fact decrease in contrast to what happened to your dividend yield ratio. Finally, your liquidity ratios, again, your current ratio and asset test. So we're going to look at one. Let's use the current ratio. And once again, let's work with some numbers here. Let's say our current assets are at 20 million. Our current liabilities, let's say at 12 million. So 20 divided by 12 is 1.67 is to 1. So that's my current ratio. And we know that the current ratio, as long as it's between 1.5 and 2, we're okay. So it seems to be okay right now. But when you do have to pay a higher dividend, eventually the cash will leave the company. That means your current assets, which includes your cash, will actually go down. So the numerator goes down in this occasion. And if we solve for this, let's say the numerator goes down to a 14. Everything else remains the same. We can now say that your current ratio has actually gone down to 1.16 is to 1. So again, when you compare the two, what we find out is that with a bigger cash outlay because of the higher dividend payment, your liquidity falls down. And again, we can see that the numbers are here to prove it, that this is actually true. So a higher dividend payment will improve your dividend yield ratio, but actually hurt your dividend cover and your liquidity ratios. Now let's compare this to what happens when you have a low dividend payment. And not surprisingly, the exact opposite will be true. And let's see how that works out on our next slide. All right, so now let's take a look at what happens when a company has a low dividend payment strategy. So what that means is that whatever they were paying earlier, they're deciding that we're going to pay a lower amount for the subsequent year. Now, for a dividend yield ratio, let's work with some numbers here again, and let's say that at this point our dividend per share was at 0.6 and the current share price was $3. Multiply that by 100, we get a DYR of 20%. Now, if a company decides to have a lower dividend payment, then the numerator will go down, so 0.6 is reduced. Let's say this goes to 0.3. Making my calculation easier, divide by 3 multiplied by 100 takes down my dividend yield ratio by half to 10%. So we can clearly see that when a company announces a lower dividend per share, it will give a lower dividend yield ratio, which means that the shareholders will actually be discouraged from investing more in this company. So when there is low dividend payment, the dividend yield ratio will go down. Secondly, dividend cover ratio, which tells you the ability to pay your dividends from your annual profit. Once again, let's work with some numbers there to see what's going to happen. Let's say our profit for the year was 15 million. Our annual dividend was, let's say, 7 million. So we can calculate that the company can pay this dividend 2.2 times. The X means the times that they can pay it. Now, what we are suggesting is that the company is reducing the annual dividend. So the denominator is going down. So let's say our numerator remaining the same, 15, but our denominator this time goes from 7 to, let's say, a 5. That will give me a result of 3 times. So what, again, that it tells us is when you're able to pay a lower dividend amount, and if the profit amount remains the same, then your ability to pay that dividend increases. You can pay 5 million 3 times from your 15 million profit. That's what it's trying to say. So your dividend cover ratio will actually increase when you have a low dividend payment strategy. And finally, for liquidity, once again, let's run some numbers here. Let's say our liquidity was, again, current assets were 20, our current liabilities, let's say, were 10 million. Let's keep it easy. We can see that our ratio is 2:1 and we're doing okay. What we're indicating is that the company is now paying a lower dividend, which means a smaller amount of cash will now exit your current assets. So your current assets are going down, but by not so much. So let's say your current assets, our numerator, go down, but by not so much. Let's say this is only in 18. The rest of it remains the same. This is 1.8 is to 1. So what we can see here is that it will not have such a huge impact when you have a small cash outlay in the form of low dividend payment. When you were paying a high dividend payment, there was a high cash outlay and it would have a huge impact on the liquidity position of the company. So your liquidity, yeah, it does go down, but by not so much. So the impact is quite minimal when you have a low dividend payment. So in the end, again, just dividends and the decision of how many new shares must be attracted and what are the dividends that need to be assigned. Yeah, in the end, it's a decision that's taken from the board's votes that are counted in. The shareholders have a say in it. But from looking at the ratios, we can see that whatever the strategy is, it will have a direct impact on the ratios that the different stakeholders are using. And I hope your understanding on dividend payment strategy is clearer as a result of this lesson.